Hi, this is Rusty Vanneman from CLS Investments for the January monthly market review, and with me is Kosha Edis, portfolio manager. Welcome, Kosha.
Hey, Rusty.
So I have Kosha here because we basically co-wrote this month's market review. So
You did the most of it.
yeah, well, we got a lot of stuff to talk about. So thanks for coming on board. And so right off the bat, both of us had this experience right away. It's that time of year. People have their performance reports, and people are saying, "How did I do last year?" And a lot of people think we didn't have a great year. I mean, think about some of the headlines last year. I mean, just think of some of those things.
Well, let's see. First, let's start at the end of 2015. We get hit with the first Fed rate hike in over 10 years. I mean, bam, right off the bat.
Seems like bad news.
And then, well, you'd think so. But then you start out the year with one of the worst market starts in history. And the second correction in less than 6 months. Mm-hmm. I mean, bing, bam, boom. Just things are going bad. Then about half year through, you get Brexit, where England basically says they want to break away from the European Union. Mm-hmm. That sounds like terrible news. Then towards the end of the year, I'm not going to get too political, but Trump very unexpectedly becomes president. And then towards the end of the year, once again, like clockwork, Fed hikes again. So you've got all these seemingly bad events all the way through.
Massively disruptive, potentially disruptive
exactly.
events. Right.
You'd think it was the worst year ever, but every single broad asset class was up, and some big time, like domestic small caps were up over 20%. Domestic equities, emerging markets, and commodities were up over 10%.
Commodities broke their multi-year bear market.
It was great to see. And usually not everything moves in the same direction, but even bonds outperformed. It was so great.
That's a great point on bonds, because bonds, it isn't just the aggregate index. There's high yield, there's inflation-linked bonds, international stuff. The way we look at the bond market, it was up about 6% last year. So up over half of the stock market return, but with, of course, like a quarter of the volatility. So it was really a good year even for bonds.
So with all of these kind of huge events that took place, disruptive events, what should CLS clients expect? Should they expect any surprises in their CLS portfolios?
I love this question because I think it actually is a question that every investor should always ask about their portfolio and their money manager is there anything about this portfolio that surprises me? And if you and I are doing our job right, if we're doing our job right, we should never surprise our investors, and that they should understand how the portfolio behaves in all market environments. And last year, hopefully nobody is surprised. And if anybody's watching this, please let us know. But first of all, we upheld our risk budget promises, risk as expected. The second promise of risk budgeting is that we will be active, and we actively managed last year. And our active decisions did add value. We had a very good year. Our flagship product strategy, those funds had their best year ever in the history of CLS last year. So hopefully nobody is surprised it was a pretty good year. And you know what? This is the January market review, and January's been pretty good too. And everything we just said, the markets are doing great, and the CLS portfolios are doing pretty well too.
Great. So Rusty, last week you and I got to travel to Florida, which was great considering it was snowing here in Omaha. So we went to the leading ETF industry conference called Inside ETF, and it was huge. And you could tell how it's really grown over time. And I think that's really reflective of growth within ETFs and the industry itself.
Yeah.
So the hot topic that I'm sure you noticed was smart beta. Everybody was talking about it, which is great because it happens to be a 2017 CLS theme. And in fact, over 50% of our portfolios are allocated to smart beta. But a topic often comes up when talking about smart beta and passive investing, and that's, is active management dead? What are your thoughts on that topic?
I have a pretty strong feeling about this. Active management is not dead. And I think that story is so overplayed. There definitely is a migration from actively managed funds to ETFs. Stepping back for a definition, what is passive? Passive is a portfolio trying to match a benchmark. So it's passively managed, and active is you're being different than the benchmark in an effort to beat it. So that's the basic definition. What we're seeing is a migration from high-cost, mediocre, actively managed mutual funds to ETFs. and lower cost mutual funds. That's what's really going on. I mean, that's a win for investors, but investors also want actively managed funds. And so the whole active to passive thing, I think, is a bit overrated.
So if active management is alive and well, what can a client do to evaluate potential active managers?
Well, we have our own due diligence list and process, but I think there are a couple attributes that really pop out, and I think it bodes well for us too as active managers. First, there is a sensitivity to cost. We're using ETFs. ETFs are lower cost, expense ratios, tax costs for taxable investors. I think that's really important. We have a long-term orientation. We hold positions on average about 3 years. The industry is, or the typical mutual fund is more like 1.5 years. So we have a longer orientation. It's kind of a byproduct of our disciplined investment process. The other thing which I think is important is that we eat our own cooking. Both you and I, we invest in the funds that we manage. Our bonuses are based off how well we perform, and we are eating our own cooking, and we are investing in the funds. I think those, if there's a couple takeaways to look for an active manager, those would be 3 good ones right there.
Excellent. That's great.
You know what? I think this has been fantastic.
Yeah.
So, and I think people should read the weekly or the monthly.
Absolutely.
And thanks for coming on, Kosha. And thank
you
you
so
for
much.
watching.